This video is sponsored by Empower. It's this cool app that can help you save and budget your money. Download the app for free. Link is down in the description below. Hey everybody, and welcome back to the channel. My name is Brandon, and in this video, we're going to be highlighting 3 spooky stocks to buy going into the spooky month of October. And I say spooky here because the first stock that we're going to be covering today, it does have me quite torn. It's the company FedEx, ticker FDX. And I do know that we're going to have some varying opinions on this stock because FedEx is a company that just reported their earnings on Tuesday of last week. A very poor earnings report. The stock was down about 13% off the back of that report, where they missed on their earnings targets. They lowered their guidance going forward. As well, they had a number of analyst downgrades from these big analyst firms. And if we actually do scan out to a longer term chart here, the stock is down somewhere along the lines of 45% since January of 2018. So a very, very rough patch that FedEx is going through. And FedEx is in quite an interesting position because a positive for FedEx is that they are benefiting from e-commerce. E-commerce, as it gets more popular and more people are getting comfortable with shopping online, that results in a ton more packages, which really is like this natural tailwind that's not only positive for FedEx, but also UPS, pretty much the entire package shipping industry. And if we take a look at the numbers, we can kind of see that reflected in their revenue growth. So revenues are growing. However, some of the other metrics aren't looking so good. As mentioned in their recent report, earnings haven't been up to par. It's been a couple, I believe 2 to 3 quarters now where they haven't hit their targets. Their margins are also being suppressed. And over the past year or so, there have been a decent amount of headlines that have probably played a big part in this drop. To name a couple, you may have heard of the Amazon partnership being canceled. They're no longer shipping Amazon packages. Albeit this did represent a small portion of their revenue, about 1.3%, but still. And on top of that, they're actually facing increasing competition from Amazon. Because for those of you who don't know, Amazon is actually building out their logistics business. So they're handling actually a lot of the deliveries themselves. And then on top of that, we do have this ongoing threat of upcoming slowdown in the economy. And I'm not saying I'm predicting that anytime soon, but a company like FedEx would be quite susceptible to that. So all that being said, I can see why this stock has dropped so much. And you're probably thinking by now, this sounds like a terrible company. And that's why I say I'm quite torn with this company or with this stock, because the risks that I've just mentioned are all legitimate risks. There's a reason why there's so much pessimism surrounding the stock, and it is very tough to buy into a stock, even for someone like myself who tries to kind of see the longer term view here. We can't overlook that on a positive side, this is a company that ships 15 million packages each day. They've also got their aircraft fleet of over 650 aircraft, which is kind of defines FedEx there. And, that's not something easy to replicate. But the point that I'm trying to get at here is that FedEx still has a very powerful network to fall back on. And, they've been around for quite a long time. They've been through the different economic slowdowns. They've been through the different cycles. But to summarize things, if we want to look at it from an optimistic view, we could make the argument that a lot of this negativity is maybe already priced into the stock. So all these headlines, all these projections that we've been hearing about on the news, maybe that's already priced into the stock, hence why it's lost, essentially 50% of its value. And if this next quarter comes out to be a nice one, which is the holiday season, we have Christmas, which usually results in a bunch of packages being sent around, and that could be a nice kickstart, kind of get this company back on track. Or worst case scenario, this could be the start of a big decline in a major industry leader, with Amazon coming in and disrupting yet another industry. If I had to lean towards one, I'd probably lean towards the first option there in FedEx being able to get through this, but that's of course up to you, the viewer, to decide. Do your own research and your own due diligence and make a decision for yourself. The stock currently trades for $148 USD. It pays a 1.75% dividend, and FedEx is our first stock to buy in October. Moving right ahead on into the second stock for today's video, it's actually a REIT, a real estate investment trust. And I will explain what that is in just a second here, but the REIT is the Northview Apartment REIT. The ticker is a little bit confusing, but it's NVU.UN.TO, and it does trade on the TSX. And I do get a fair amount of questions on like, what are your opinions on REITs, or what are some good REITs to buy? And I actually don't personally invest in any REITs. That's just my personal preference, but I do have a handful that I follow. Take the Boardwalk REIT being one of the popular ones. We've talked about the Brookfield REITs, or the Brookfield REIT, I should say, on this channel before. And in this video, we're going to be highlighting NVU, the Northview Apartment REIT. And one thing that you'll notice right off the bat is the dividend. 5.5%, which is really awesome. That's an awesome yield, but it actually is quite modest compared to some other REITs. It's very common that you'll come across a REIT that's yielding 7, 8, 9%. And in some cases, you'll see them as high as like 11 or 12%. So a very, very high amount of income, a very, very high yield that you're pulling in from these assets. And that's because if you're not familiar with what a REIT is, a REIT stands for a real estate investment trust. And what that is basically a company, a trust, or it's a company that owns a portfolio of real estate. So in many cases, it's things like commercial buildings. So take like a doctor's office or office buildings, maybe like a shopping center or a strip mall. There's really a bunch of different types out there. And what they do is they rent out or they lease those spaces, or they lease those units, and the income that they're pulling in, a very, very large percentage of that just gets flown through to the unit holders or to the shareholders. That's why we see these very high yields, and in many cases sustainable with a REIT. And Northview is a REIT that focuses on multi-family apartments, so residential units. And we see here, this is just reading off their investor presentation. They are one of Canada's larger multi-family REITs with a portfolio of approximately 27,000 residential units, as well as some commercial spaces. So they have about 1.2 million square feet of commercial units or buildings as well. And that does span across many areas of Canada. And one thing that I like about a business plan like this, a REIT that invests in residential units, is that they are, for the most part, pretty stable. They're pretty reliable, because even if we are headed for an economic slowdown or really whatever phase we're at, for many people, the top priority is keeping shelter, keeping a roof over their head, and keeping food in their bellies. And that's why when it comes to your monthly bills, top priority is probably going to be rent, your utilities, food, and then we start trickling down into more of the discretionary items like, your Netflix account and your Crave account. And that's when those are more or less the subscriptions or the bills that may be more susceptible to a slowdown, where you ask yourself, do I really need both a Netflix and a Crave account, or do I really need this much data? Those ones are far more likely to take hits, rather with a company that invests in real estate and is providing people with homes all throughout Canada. So if you're an investor that is seeking some income, this could definitely be a cool one to look into. And I'm sure a lot of people will be happy to hear that they pay their income out monthly. I know a lot of people find this attractive. And by taking a look at the share price, it has been appreciating quite nicely, and it does pay a reliable yield. And, I came across I clipped this comment here from somebody a couple weeks back. He said, I've held NVU since 2015, purchased it below $25. The appreciation has been solid, and it pays out a dependable dividend. As a retiree, that's all that I can ask for. And that to me is just the exact type of person that would benefit from an asset like this. So if that's you, The REIT currently trades for $29 USD. It may be getting a little on the rich side, but it's one to throw on the watch list. And if you see a pullback of a few points in October, definitely a cool one to look into. Moving on to the third and final stock for today's video. It's a stock that I actually used to own. It's the company Husky, ticker HSE. And I did sell the stock a couple years back. At the time of holding the stock, it was not paying a dividend and it just kept dropping and dropping and dropping. So I said, why am I holding this stock? Now, if we take a look at the share price here, the stock is currently yielding just over a 5% yield. And the performance of the stock has been not good. It's down about 80% over the past decade, really. Very poor performer. And many of you will recognize Husky because maybe you visited one of their gas stations. This is, of course, one of the major energy companies based out of Alberta, Calgary. And the gas stations are just one aspect of their business, is the retail aspect, but as well they do offshore drilling over in Asia, the Atlantic, as well as other means of producing heavy oil. And that's both in Canada and some parts of the US. And if you have been following the channel over the past couple of months, or if you're a member in our investing academy, you guys know that I've actually been seeing some nice value in this sector. I recently added the stock in Canada, a peer to Husky here. I added in Canada to my portfolio, and now that Husky's paying a dividend again, I think that this could be actually another very suitable option. And as I mentioned, I sold the stock a couple years ago because here is this little drought period. This is what I was talking about when they were paying no dividends, and the stock was just dropping. I thought, what's the point of holding it if I'm not even being rewarded with the dividend? They now pay a dividend of about 50 cents per share, which again is up in that 5% yield. And there's not really too much to say about this company. I'm not one to analyze energy companies all that much, but maybe you're looking at the performance of this stock and say, why would I ever touch a stock like this? And my argument to that would be, by taking a look here at the PE, a PE of 7, this company, this sector is really out of favor, and they're actually offering some cheap prices at the moment. And if you do believe that companies and sectors and the world of the stock market all moves through its cycles, which is something that I personally buy into, despite the past decade being terrible for a stock like Husky, that doesn't mean that that's going to be the exact same, 10 years going forward. In fact, at these prices, with the stock dropping like 70, losing 80% of its value, I'd actually expect the opposite for that to be the case. We do just have to keep in mind, of course, when we're talking about a stock, tied to a commodity like oil, this is going to be more of a high-risk stock. More of a volatile stock. In other words, we're going to be seeing some heavier swings with a company like Husky. And a fun little stat I could share with you here. Some of you will know about this, some of you won't, but it's what's called beta. And for a company like Husky, we see a beta of 1.9. And when it comes to beta, the higher the beta, the more volatile a stock is. Like if you had a stock with a beta of 1, for example, that stock would be very correlated. It would move very similarly to the market, to the broader market. If the market was up a little bit, so would that stock. Now, as the beta gets higher, 1.2, 1.5, or in the case of Husky, 1.9, that means that if the market moves this much, Husky stock is going to move a bunch more. It's going to be amplified in terms of the swings, and that's both positive and negative. So that is something to just keep in the back of our heads and fully understand if we're somebody that wants to invest in this stock, because it will likely be a bit of a wild ride. And if you're somebody that does have energy stocks on your watch list, I'm sure you'll notice that. You'll see the TSX move this amount, and in Canada, Cenovus, Husky, they've been flinging all over the board. So it could without a doubt be a good option for somebody seeking income now that they're paying this dividend, nice dividend yield, with, in my opinion, actually some opportunity here for capital growth. Just understand that that will come with that additional volatility, but the stock currently trades for just shy of $10 Canadian. pays the 5.08% dividend, and Husky is the third stock to buy in October. So guys, those are my 3 stock picks for today's video. Do you like them? Do you not like them? Leave a comment down below as to why. And if you enjoyed the video, I really do appreciate it if you drop a quick thumbs up, and you can subscribe for more content. We post a video here every week. As always, if you are a new beginner, if you're a new investor, if you're a beginner investor who's looking to learn more about investing, you really want to tackle the stock market with a full understanding, be sure to check out our Investing Academy. It's that first link down in the description below. Check it out, possibly enroll as a student. There's a free training video down there. But as always, I thank you guys for watching. I really do hope you enjoyed the video, and I'll see you in the next video.